Hi, welcome back to Conversations with Curio. My name is Stefan Revelo. I'm joined here by my colleague, Liz Gillette. And in today's episode, we're going to be talking about the market. We're going to be talking about the craziness that's going on in the world, the fears that we see people experiencing, and kind of what are some things that you can do and shouldn't do during this time to keep yourself afloat during this time of uncertainty. So we're going to dive deep, have a good conversation about what we're experiencing, what we're seeing on our end, and kind of just, yeah, go from there, see where this conversation goes. So, Liz, welcome back. Dare I ask, how are you doing today?
How dare you, by the way. For our listeners, today is March 21st. When we're filming this, it might become relevant because by the time it comes out, we don't know where the market will stand on that day. So just to give you a little bit of insight, I'm doing very well. Thank you, Stefan. I always say my little micro world is doing well. The kids just wrapped up basketball, and my two bigs are getting into baseball and lacrosse. So warm weather's here. Life is moving forward. When you're in the Northeast and you're not in Florida like you, there's just a lot of energy in the air as the weather heats up. So I'm excited to get going today. Yeah, I'm excited to chat about this. It's certainly top of mind for just about every client that we talk to.
Yeah, no, that's certainly right. We've been in high demand, as we've been saying, as of recently. Calendars blowing up, clients calling, feeling worried, feeling if they need to do something. Which super normal. There is a lot of crazy things going on in the world, and I think in today's conversation, I want to talk about not only things that you can be doing, but also break some myths and break some things that people think are a fact. And actually, if you look behind the data of some things just become saying over time, but they're actually not even true. I mean, for one, this example, being a financial advisor, the first time I ever even lump sum to money ever was during COVID's downturn in 2020. And at that time, markets were going down at a pretty rapid rate. And it was in a short time period. But I remember putting a lump sum of money, about 1,200 at the time, and it just kept going down and down. And I realized, oh, maybe I'm not good at this investing thing. Why did I get started in this? I put money and a month later, my account has dropped freaking 8% or whatever it was at the time. So I truly thought that I did the wrong thing. I was like, this was a mistake. I should be pulling out right now because everything is down. So yeah, that was literally a thought that I had in my head. This is before my advising career. But the truth is, the reason why the fear came was not only uncertainty, but I think just not informed as well. I didn't know what was going on. I just saw red, 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 and I should be seeing green, I was told. So I felt that I was a loser and good for nothing at that time. So, uh, yeah. So to talk to me, Liz, tell me if my feelings were valid or if they're true or some things I could be feeling at that time.
You really put me in a position to make fun of you. You know, like, is it true, all loser? No, Stefan, you're great. Yeah, it's interesting. And when we go through these market corrections, it hurts. Like you feel it to any investor, or we say students of the market. Like it can feel very chaotic. It can feel very unpredictable. Um, and I was talking to a colleague the other day saying it's not that different than parenting. Like being a student of the market means that it's really chaotic, it's really unpredictable, but hang in there because there's long-term payoff. And I think that that's honestly true. What we're living in right now, we just went through two really good years. I mean, like double digits in the 20s of S&P 500, just as a benchmark for the market as a whole. So, both with the change in administration and other global changes happening in our country, it's got clients feeling pretty fearful. And I know one thing you and I were going to cover today was about how the psychology of money, works. What are some of our like behavioral heuristics that work against us? Like, why is our brain putting us in a position to pretty much turn us into bad investors, which is why you and I play the role to be like the steady steady in the storm for our clients. So give our listeners like some examples of ways that our brain is set up in a way that makes us not maybe be the best listeners or the best followers of the plan when things get tough.
Yeah. Yeah. It kind of goes back to my story in the beginning of when you see markets going down, it's, oh my God, the world is falling apart. That's what I was thinking. I'm not good at this. I need to pull out immediately. That was just the first thought in my head. But then, kind of obviously looking back now, it has rebounded pretty well, and it rebounded very quickly at that. And when the market started going up and my money was growing, I was like, this is good, like awesome. But I was super nonchalant. It wasn't like, oh my God, this is amazing. I'm going to pump more money into the market now because it's doing so well. I was only experiencing that on the downside. So on the downside, I was freaking out. And then on the upside, I had this expectation that, oh no, isn't that what it was supposed to do? But my feelings weren't as enthusiastic about it. I think that's kind of similar to like when you go to a restaurant and you have like a terrible experience, you're quick to jump on Yelp and say, this was horrible. I'm never coming back to this place. This server was garbage, whatever. People are quick to just complain and they will make their opinions known about it. On the flip side, someone has an incredible experience. They tip their whatever 20%, and that's it. They didn't tip more. They didn't necessarily go on back on that Yelp and say I had this amazing time. It was just kind of, no, I should have, this was good. It was a good time. But when it's bad, the world's falling apart. This place sucks. We're never coming back. So I think there's similarities in both of those things of seeing we're quick to jump when it's negative, but when things are going well, we don't really sit to take the time to like either enjoy or appreciate what's happening in the world.
Yeah, survey results show that. Like you try to get the average, but the reality is the average person is not commenting in. So you hear the barking on one side and the praising on the other. And our brains are set up to remember the bad more than the good, right? We are physically wired that way so that we know to run away from the saber-toothed tiger because last time we saw him harm someone. Like that is how we are set up. And so we have this loss aversion. So there's tons of data to support the fact that if you offer someone, do you want to get, a 10% gain, but it will potentially put you in in an opportunity to lose a 5% loss, or do you want to get a 5% gain and a 0% loss? And someone will refer to themselves as risk tolerant, but when they're actually asked that question, so many times you say loss aversion, loss aversion. So that's one piece of it. Anchoring is another one. So a lot of people probably know about anchoring if you think about salary negotiations, and whoever throws out that first number, the two or more people in the room are anchored to that number. So it either seems, higher or lower based off of that. There's the flipping of a coin. There's flipping of a coin. And if you get 5 heads in a row, your brain is convinced the next one has to be tails when probability tells you that it's same 50-50 that it always was. So these are all the things that come into play in investing. I used to have this little fun graph that I would keep on my desktop. Sorry, listeners, I don't have it with me, but if you really want it, I will hunt it down and send it to you. But it was, I think, 20 psychology heuristics that come into play when it comes into investing and how our brains are hardwired to get us to react when the going gets tough. Yeah. So what are some of those things that we should be doing, Stefan? Like if we are hardwired to be working against ourselves to being good investors, then what are some of like these actions? Like there's got to be something we can do because everyone's feeling pretty antsy right now. So I shouldn't say everyone. Many people are feeling very antsy right now. So what can we tell them? What can we tell them?
Yeah, that's been the main theme of our last meetings, the last 4 months of coming in, the client sharing their fear, and then asking the question, what do we do? What is the next step that we take? And for various people, it's going to depend. But for one thing, it's stick to the plan. And that's, now I'm talking in a client sense of we have built a plan with all of our clients. We have goals. We have timelines to achieve those goals. And then we're invested in a manner to hopefully, and we have strong conviction that you will achieve those goals in the timelines as discussed if you continue the client doing the things, saving where they need to, controlling their spending, doing the boring old stuff that works and no one wants to do them, but it's the things that are tried and true that are consistent. And we want to say stick to the plan. Now, the caveat there is to have a plan in place. So if you're somebody that hasn't, and I'm not saying you need to work with a financial advisor, but if you haven't gone through a process of evaluating your own financial situation and saying, I should be invested in this manner because of this goal, or just making sure your goals and your portfolio are aligned in terms of timeline, in terms of risk. If you have a plan in place, the plan should be stick to the plan. External factors are always going to change. Who's in office, who's policy, the Federal Reserve rate, changing rate, all that stuff is going to happen that we can't control. But we can't control our own actions. So granted, if you have a plan in place and you've had one for years, which for some of our clients, it's been 3, 4, 5, 6+ years that they've been working with us, they know to stay true to what has been working. Because some people want to jump ship to what's the new opportunity? What investment strategy should I change? And we always combat of, has your goals changed? Like that has to be the driving factor of constituting a change. So sometimes not making a change is a change. And not even is a change, it's an action. Not doing anything is an action. Again, another analogy, they're just flowing through my head right now. I don't know why. But let's go back to high school. You're at a high school party, and most people are doing things you shouldn't be doing, right? Let's say they're having some beverages that you should not be having. This is a common situation in high school. Let's say you have one. You say you have everybody that's having a good time. That's not. Then they're just drinking. They're having a jolly old time. And let's say there's one individual in the corner who's not doing anything. They're not partaking in it. They're not falling into the peer pressure. Is that person doing nothing? It's like, no, they're yes, in the sense that they're not partaking in that action that everyone's doing, but they're staying true to their values. They're staying true to their health. They are not falling into everyone's doing this, I'm going to do this. They're doing nothing. They're literally being boring. People will say, oh, this person's late. They're not doing anything cool. Come on, man. It's like, take a drink. And it's like, nah, I'm okay. That person's actually doing the most out of anybody in that room while everyone's actively drinking and throwing up and doing whatever things you shouldn't be doing. The one person doing nothing in a weird way is doing the absolute most. They're the mentally strong. They're true to themselves. They're sticking to something that was probably practiced at home, taught by their parents, whatever the case may be. But they stay true to a set of principles that they're like, I don't like the taste of it. I don't like how it makes me feel. So I'm not going to do that action. And I see investing as the same thing. If you do the boring old thing and not just say everyone around me is selling, I need to be doing that. That's maybe not the best strategy for somebody that's in that situation.
Wow. I'm impressed by that analogy. Did you do that or did ChatGPT come up with
No,
that?
I actually came up with that I didn't even have that coming in today. I'm going to be honest.
Whoa. God damn, I could learn a thing or two. No, exceptional analogy. Yes. It's this feeling and this driving feeling that like, I don't want to be left behind. So typically with investing, we talk about these 3 categories. Investors and humans are driven by fear, which is the part that you're talking about, where you take your money out of equities or take your money out of the market, put under your mattress, or put in something that you believe to be safer, right? Again, we could argue that there's risk in everything that you invest your money in, but perhaps you're taking market risk off the table. Sometimes we're driven by greed or FOMO. And that's when you look and you see NVIDIA and Apple and you say, can you imagine if I got in on those things at the very beginning and what a good spot I'd be in. And then, I would say kind of like this third one is sitting in this category of what if I'm too late to react? What if I could have like prevented some of this hurt that they believe the market or the economy is going to experience? And, that's not so much of a fear of missing out. That's more of a fear of regret, I guess, is what we'd really call that one. So, I listened to your example and it's just very true. Like the action of choosing, it's like every time you say no, there's another yes. It's that idea that like you're actually choosing something with that decision. And I look at these questions that clients are asking, like, what do I need to be doing? How do I need to be acting? And you can't help but think your investment portfolio is something that you change right now while this is going on. One thing that we found helpful to communicate to clients is the idea of the market dropping, of a recession, is a healthy component of a normal market cycle. And so to us, right, we do this day in and day out. So to us, we're like, right, we went through a bunch of years of a high and now we're going to go through some lows. And then that's how you get the gains. That's why it pays off being a long-term investor. But we have to recognize that's not how clients feel. This might feel like something new happened. What are we changing? And to us, we're here going like, this was baked in from day one. Yeah, like this is part of the plate. We never know what it's going to be. We didn't know about dot-com bubble burst. We didn't know about tariff wars. We didn't know about COVID. Like, we're never going to pretend that. But the reality is, as an investor, this is when things pay off to be able to invest in the long run. So I have a plan that I did not tell you about in advance.
Okay.
We're going to keep things interesting. Okay. So I am going to be the client that's very fearful and that's very upset. And I'm going to tell you what I want to do and the moves that I want to make. And I'm going to try to really come with some like rational thoughts that are in investors' heads right now. And I want to see how you handle it.
Let's do it.
Live. Okay. All right. So Stefan, I saw that the market dropped. It's going to continue to drop. No question. I feel that it's absolutely going down. Why can't I just like take some of that pain away? I promise I don't want to stay out of the market forever, but I really, really can't tolerate the fact that I'm just supposed to sit and watch it go down when, in my opinion, it's a damn near positive thing that is going to happen. It's an absolute. So why won't you let me take my money out of the market?
No, I mean, one, that is a ridiculously reasonable request. It's a reasonable concern. Right now, there is all this craziness going on. You turn on the news, and you're not going to walk away with a smile. You're not going to walk away. You're definitely not going to walk away feeling good and confident in not only your investing, but just your life, your portfolio. You're not going to feel good. So it is extremely reasonable of why you feel that way. And you fall in line with a bunch of other people who have that concern. And I'd be lying to say that I have all the answers and I'm not worried about it. It's certainly, we don't like seeing our money go down as well. So it is an extremely tough time. And your question is, why can't you pull out? So I would ask a question, and we'll get to recommendations, and I'll tell you my professional opinion on things. But when it comes to that concern, is there a specific headline that you saw? Is it just, oh, no dummy, it's just you turn on everything? Is there a specific event, or is there a specific kind of topic that is really hitting this pain point right now?
It's all of it. Like, I read all the best articles, and the economists say that these tariffs are totally going to destroy us and they're going to send the economy into a tizzy. I believe I've seen that investor sentiment is down, and I know what that means. That means investors are feeling scared. I see notable people moving their money to cash, and I trust their opinions. So as a whole, I feel like it's very certain that the stock market is going to move down. I'm not saying I'll stay down forever. I don't want to get hit with this when it feels like we could be smarter. Why aren't we being smarter about this?
Why aren't we being smarter? That's the $1 million question. No, but do you recall when we talked about risk? Do you recall when we had discussions regarding how we baked this in the first place when you started work? I know it's been a few years since we had these conversations, or when you first onboarded and we really were hammering that point. But do you recall that conversation of when we discussed what strategies or what things that we take into consideration when we're baking in risk into your specific investment account?
For you guys saying we're not shooting for the highest possible return, we're shooting for whatever's the right amount of return to reach my goals. I remember you saying that, so I know I'm not 100% in the market. I know that when I see the news, it's about the S&P 500, but you guys are always talking about diversification, so the money's not just in S&P. Ugh, I know where you're going with this. Yeah, my money is like spread out, and we all, me and myself included, were prepared for it not always to be good days in the market. Is that what you're getting at?
So I'm gonna break this role play right now and just talk. I was gonna talk about just the reality of when we work with clients. These are things that we do actively talk about, and it's things that are baked in. What Liz was saying. This is an I don't want to use the word healthy part of the market, but this is just a natural thing that happens. And the thing is, these companies are still trying to make profit. Like, think about the big companies that are in the market. They're not just sitting around saying, "Oh, well, we're screwed and we're just our stock price." And so they're feeling that stress because of us. I mean, as the investors, they're supposed to serve the investors and say, "How do we grow their wealth?" And the conversation you heard us having, this role play, it seems boring, and it seems that we're going back to you heard me reference a past conversation, is because the action is to do the boring things and the boring diversification, stay in your seat. We're trying as advisors on the inside, we are trying to find ways to really not only present the information in a different way, but to do it where we're still giving clients the autonomy. We're still validating their feeling, which is valid. Like, it's scary. We're not just these optimistic people. We're worried as well. We just have to have that strong face for the client to let them know that they're going to be okay, that their plan throughout if they've been investing for 10, 15 years, they've experienced these things. And the old saying of, but this time is different. Of course, there's no two things that are ever going to be the same. Two kids are growing up in the same household and they have different perspectives on their parents. One would say, my parents are strict. The other one's like, oh, my parents were super nice. As the younger kid, between my brother and I had it way easier than him. He had it tough. He had curfews. He had all this. I could do whatever the heck I wanted to do, at least as the younger one, because they knew I was okay. So it's kind of the same here. So everyone's gonna interpret information here differently, but it is truly going back to the boring basics and just staying true to the original plan. And in that role play, that at least that was what I was trying to demonstrate there, without heads up. But it's just to stick to the boring old things, like the whole, well, what works, what should we be changing? It truly is recalling past conversations because we have addressed these points. It's just this pain point is being pressed right now, and it wasn't being pressed when the market was doing super well.
Yeah. Yeah. For the record, I really liked how you handled that. And I felt very heard. You didn't seem like exasperated with me, no matter how many of these phone calls you've taken today or this week. You really seemed like you were listening in, you were understanding, where it's coming from. And what I will add to that is in these conversations we're having with clients, if we play out this scenario where we make moves right now, right? Like, let's just run with this. So if the client says they really want to make a move, because don't let us forget to talk about when would we be okay with the client making a move. It doesn't mean that, first of all, you threw out the word autonomy. Like, that is an absolute key component of this. They always have the control. But it doesn't mean that we come in and just give a speech every time. We actually are considering their circumstances. So don't let me lose that, okay? Because I want to make sure we cover that. But the thing that comes to mind for me is if you play it out and you say, all right, so we let you pull out, maybe you recognize there's some pieces of the market that do well during a recession, right? The defensive stuff. People still have to buy groceries and gas and healthcare. And so if you even play out that scenario with the client and say, all right, well, let's say we changed up your investment strategy and we started to focus in on these key areas. One, we have to admit we're being quite predictive about something that no one has been able to do before, which is predict these pieces of the market. No one would have predicted that European stocks are doing exceptional right now. You can find plenty of articles that said, should we even be investing in international stocks as of 6 months ago? So obviously we can't predict these things. But if you were to say to the client, okay, so we pull out of this stuff, we put more money into this, the reality is we're giving up that diversification, which is like the name of the game of investing. So when you said stay the plan, Stefan, your point is from the beginning, we're not just in US large cap stocks. So when tech is down the way that it is, there's a reason why we didn't let our clients only be in the Mag 7 from the beginning. We have them in large, mid-sized, and small companies. We have them in growth funds and value funds. We have US, we have international, and then that's just the equity side. And then our bonds are nice and diversified as well. So I would very much, when I walk clients through that, I remind them that you're giving up one risk. You believe you're pulling yourself out of some market risk, but do you see how you're introducing yourself to a new risk of not being diversified? Same sort of thing if you move to cash. So if you say, I'm going to do something dramatic and move my money to cash because hell, bonds are still an investment. So you're still exposed to the market. Well, now you're fighting inflation. And so like, yes, you traded in market risk, but you're just replacing it with inflation risk. I have a little chart that I want to show you guys that I think will be helpful. Can you see it okay on your end, Stefan?
Yeah, I can see it.
Okay, so this is called the growth of a dollar. And it's just representing, since the stock market opened in 1926, why do we have these different investment vehicles, right? Like what's the performance of stocks versus keeping our money in cash? And then where does cash actually compare to inflation? So if you just hung out here, can you see my cursor?
Yeah.
Sorry, I don't know what shows up on the recording or not. So you can see that cash beats inflation. So like there's some over the long run, there's something to be said for saying, okay, if I put it in a high yield savings account, at least I'll be beating inflation. But this paints one heck of a picture of why we all expose ourselves to the scary piece that is investing in equities. It's because this is what allows us to truly beat inflation. That's what allows us to get the growth that we need for the success of our portfolio. So in the scenario that you move to cash, like I said, you're taking that off the table and then you get into market timing. And so in order to get this right, you're trying to predict exactly when to get out, which I won't say it's a little bit easier, but certainly there are times in history that it feels quite certain the market is going to move down. Some people would argue that's now, some people would say that's not the case. But getting out and saving yourself from some of the pain, that's possible. Right? Like you get out now, the market goes down and you go, yes, like I did it. When do you get back in? Like that's the really tricky part. And I can't remember if I said on this podcast before, but I worked with a client who came to me after the pandemic. And Stefan is like, if she tells a story one more time, I'm going to die. Bear with me. But a client came to me after the pandemic being like around 2013. And she was in her 60s and she said, hey, good news. Like I managed to pull my money out before all the chaos started in February, March of 2020. I said, oh my God, that's incredible. She said, her background was actually in like diseases and prevention. And she was like, I felt like we were headed towards this big event. I said, wow, that's great. So she pulled her money out. And I said, well, it seems like you have it all figured out. Like, what are you looking for the help from a financial advisor for? And she said, well, I just need you to tell me when to get back in. And even retelling the story, we all know what that graph looks like, where the market went down and how we were all the way up here. So she exited the market here. She prevented this loss, but now we're sitting like right here. So you sold here and you're going to buy here. And even what's happened since the start of this new year has not put us anywhere near where she sold at in 2020. And so, we have all these real life examples from clients of pulling out of the market and not knowing when to get back in. And so if you want to shift your investments towards defensive, it's the same question. Like, when are you going to shift them back? And why would you take diversification off the table? This is another graph that I think speaks really well to this topic, which is the pain that you can experience from an investing perspective if you miss some of those big days in the market where it corrects itself, right, Stefan? It's all about that initial one day, first week, first 2 weeks, first month. So the way that you're going to read this graph is this is the S&P 500, and it's saying what is the growth of your $1,000, very similar to the growth of a dollar that I just showed you. And if you hung in there during this time period, you got about a 10.21% return. Mind you, quite a few events happened during this time period, right? This is the dot-com bubble burst. This is 0809. This is COVID. I mean, this is a lot of rough stuff. And if you hung in there, you got that maximum return. That 1,000 turned into $27,000 during that period. This is where it gets so interesting. If you miss so much as one day as you are trying to predict which day to jump in and which day to jump out of the market, you only lost your stomach for one day. You have almost a $3,000 difference, and you got your percentage annual return down to 9.85. The story gets even more interesting if you simply mess up 5 days during what is a 33-year period as an investor. So I look at this information, God forbid you tried to stay out for a month, right? And you happen to miss the best days. So I look at that information and it just tells such a story of like, how the heck are you going to get it right if you time it? So sometimes it helps investors and our clients to understand, like, sure, let's walk through it. If we make these moves, then these are the other risks that we are facing, you know? So I did not forget. So you tell me what those scenarios look like in the event that we would say to a client, you know what, we are making a change to your portfolio.
Yeah. Yeah. So there are times where you will make a change. But before I want to share a quick example of that, but just to harp on what you were talking about of it's the boring things. Don't be reactive. Have a plan. Don't panic. Don't just give in. And we have right here. I keep these on my desk. This beautiful thing right here. These are our investment principles. We got 10 of them here. I'm obviously not going to go through all of them, but we have a ton of conviction and confidence in our principles. So if we tell a client to, we don't urge clients. Clients always have the autonomy, but we're always going to try to harp on the principles and stay true to the plan. And we're willing to go down on that sword. If we continue implementing what we're doing and the market goes down and people say, you are trash, you want to fire us, we are honestly, like, we're not okay with that. We would love to continue working with you, but we're not going to just switch up to appease a client or just say, oh no, we're going to make this change because, like, we truly are looking for your best interest. And we have all the data. We have a ton of data. We have a ton of just different scenarios, different things that have happened where portfolios, the markets have stood the test of time. And you can go back to 1990. That was the chart you're showing. You can go back to the Great Depression. You can go back to whatever time period of seeing rebounding. And it truly is just in our conviction, in our principles, a conviction in our plan that we feel good recommending that. And even if it doesn't go as planned, we're willing to fall, at least on that sword. What we're not willing to do is fall on, we make a change to go more into the energy sector, it bombs, and then we say, oh, we've never done this change. We tried it once and it didn't work. We do not want to play that game because then that's just a roulette table. We truly, if we go down on things that we truly believe in, then that's just what's going to happen. But we try to stay true to what the things that we have full conviction in. Now, to your question of when do you make a change? It's not always just stay the course. Don't say, no, there is times where it's like, yeah, dummy, let's reduce, let's take some money out of the market. I need some of my money in the short term. And I'm going to simulate this 30-minute phone call I had with a client in 2 minutes. But it basically went, I recently lost my job, which was unfortunate. So we talked a little bit about that. I am retired now. He was planning on working a couple more years, 2 or 3 more years, came earlier than expected. He's like, I'm not going to try to find work again. We had his account currently that we manage in a 70-30 portfolio. What that means is 70% stocks, 30% bonds. And he says, I'm freaking out. One, I'm not having any income now, so now I'm fully retired. So that's his own concern. Forget the market. He's concerned now that he's retiring and he's going to need to start withdrawing money from his portfolio. That's the concern here. The concern is shifted from the market that he started on the call to, no, the real thing was, I'm going to stop working, not get a paycheck. Like, that feels weird, as it should. We work our entire life, and now that faucet has been cut. So how do I withdraw from the portfolio? So we talked about that. How much do you need on a monthly basis? How much? And I'm helping him set it up, the logistical pieces. And he said, since now he's retired, this money was going to be invested for another 3, 4, 5, 6 years. That's no longer the case now. He's going to start withdrawing because retirement, it wasn't his own choice, but he's not retired. He lost his job. So he says, I'm very concerned about the market. I said, great. You're concerned. You're 730. We'll drop to 50-50. And then he was like, perfect. That sounds great to me. And I asked him, do you know why I'm making this change? He was like, "Oh yeah, the market's down. Warren Buffett just put 300 million into cash," and he was giving me a lot of good points. I'm not trying to mock him. He was giving very valid points, but I said, "We're making this change. I just want you to know it has nothing to do with the market. I don't care who's president. I don't care about the news that came out about tariff. Like in terms of that, I don't care. I don't care as I evaluate your portfolio. That's not what's going to cause us to make a change." I was like, you told me specific things of you're no longer working. Your money should not be as invested aggressively because you're going to start needing the cash. You're going to need whatever amount he needed each month. I won't show the amount, but he needed a certain amount each month. I said, all right, we're going to create 6 months worth of that amount, and we're going to put it in cash so that you have access to it whenever you need. And I wanted him to be clear. We're making this change, but it's because your situation has changed. Your retirement and timeline came sooner, so we have to be less aggressive. We're not less aggressive because of the news and the market and all the other turmoil. We're making a change because your individual situation has changed. Your goal has changed. Your need for the money has changed. So that's when I felt very comfortable. It was a quick call, and he thought I was appeasing that, like, oh, I just want to drop. I just wanted to be clear that it wasn't for the reasons he thought. We both agreed on the outcome. It was interesting. We both agreed. It was super easy. But I wanted him to understand the reasoning and to understand the thought process so that when the next downturn happens, which will happen, I'm going to say, hey, Kyle, remember that conversation we had? Remember the one when you called and I told you I'll record it. It's recorded. I'll reset it to you. And I told you it had nothing to do with the external market. And that's just important that constituted a change. It might be, we tell clients all the time, but yeah, put 10K more in your emergency fund. Draw back a little bit of retirement or draw back from your investing a little bit, put some more cash. You're concerned. But we're not making these crazy changes. And when you do make those crazy changes, it's because there is a significant difference in your life. And that is what would cause you to make any sort of change there.
Your individual world, your life is not in the place that was in when those numbers made sense for you, right? I mean, that's the reality of it. And for people that aren't retired, that may look like when we set up their emergency fund and we ask them, okay, how many months if you lost your job would you be out of work? And they gave one answer a year ago. And now, based off of some changes, that have happened, they say, well, wait a second. If I lost my job, first of all, that feels like a higher probability. So I would naturally like to increase cash. Second of all, if I lost my job, I'm worried about my ability to get rehired. I feel like my industry is oversaturated. The funding that was going into my industry is no longer there. So, for example, the federal employees that we work with, if they were to normally just move to the private side, if the funding has ended on the private side, this is like a whole career shift. So when they originally said, oh, it would take me 3 months to regain employment, and now the answer is, oh, let me figure out the direction of my career, which was not the circumstances, then of course that warrants saying, let's have some extra cash. Let's get you in this position. Because one of the phrases that you'll hear, either fact or fiction would be kind of fun to play out, but is like, is cash king during a market downturn? And, I guess I want to know your thoughts. I'll give my initial thoughts. On the positive end, it's super valuable to have this cushion that is not participating in the market. It's why we have all of our clients set up with your foundation of your emergency fund. No matter how much we see the power of investing in all those graphs, we're never going to let you move forward until you have your safety net and until we've thought through the cash goals that you need to be prepared for. And so, yes, cash is king because it's great to not have to experience the highs and lows of the market. But on the other end, the market is on sale every single time that you have an ability to be buying in. Kyle, not so much buying in, no new income's coming in. But for all of our clients that have a 401k or a retirement account, an investment account, right now, because again, on today's date, the market is down a bit, the ability to put that same $500 in the market and you're getting more shares for it, you're getting more bang for your buck, is really valuable. So Stefan and our conversations are really flowing between everything from a client saying, let's start at the background, at ground zero. How has your personal life changed? Is there anything impactful you need to tell us? And if that answer is that everything's status quo, our clients are reaching into their pockets and going into their seat cushions, and they're trying to find any amount of money so that they can put it in the market so that they can benefit from when the market eventually makes its way back up. right? So, yeah, what are your thoughts on like the value of cash during a market downturn?
Yeah, cash is king. The whole kind of Dave Ramsey philosophy, um, and I would say cash is king, but you graduate to the point where you can have that opportunity. Like you mentioned, if you have no emergency fund, I don't want you here talking about I'm waiting for this opportunity. If you're not saving 15, 20, 25% into your retirement, I do not want to hear. I don't want to hear. I'm going to try to educate and advise on we still have to build up these building blocks before we can say, now, if you're at that point where your emergency fund is fully funded, you're taking care of retirement, you're taking care of your goals in the short term, you're handling your cash flow. Now you have an opportunity to start stuffing some extra cash away. Now you have the opportunity to go more all in on a lower time. Again, stock market is the only thing when things are on sale, people don't want to buy it. Everything else, clearance this, clearance that, everyone's buying. Stock market, everything's 20% off. I want nothing to do with this. I actually want to give you back all the things. It's just an interesting, back to the psychology of money, how it's a product that you could buy, like it's a commodity in the stock market, and it's on sale, and people are saying, I want nothing to do with this. I just find that very interesting. Yeah, so it basically just comes back to what is your goals? Stay true to the principles. If you watch this entire thing and you heard, man, they talked about the boring diversification, they talked about the boring stuff, I will be happy. I will say, I am glad I got my point. We got our point across of say, I didn't get anything besides stick to my plan. That's kind of the point. It truly is finding a plan that works, doing the hard things over and over again, which is investing, which is working, saving money. Focus on that. Try to keep your blinders on the things you can control. I'm a baseball umpire. I make terrible calls all the time. And they're like, this blue sucks. He missed that call. 100%. I botched that call. Well, what can the player do? They can react. They can control how they react. They can control their emotion, not throwing their helmet, saying this blue just sucks. Yeah, you terrible blue. I'm like, yeah, that's why I'm not in the major leagues right now. That's why I'm in this field right now. It's because I'm not that good. That is correct. So just don't get caught up. It's easy to get caught up in just yelling at an external factor. Me, in this case of umpiring, it's easy to just say this guy's trash, but it's also just, what could I have done better? Could I have taken an extra swing in the cage? Can I ran that extra sprint to beat the step by quicker? There's things that you could control that could have altered the results in your way. And all we can do is stack the odds in our favor. We can't make guarantees that you're not going to lose money. We can't do any of that. All we can do is say, we're going to do the best we're going to do all we can with the knowledge we have to put you in the best situation possible to achieve your goals. We're not going to guarantee a certain percentage. We're not going to guarantee you're going to be rich and none of those guarantees are made. We're going to guarantee you have conviction in your finances, that you have confidence, that you feel that you're going to achieve your goal. That is something that I will put my hat on all day long. To say you're never going to lose money, that's just a natural part of investing. So you got to take the good with the bad. So thank you guys. I know we kind of ran over here. Me and Liz could talk about this for another freaking 3 hours, I'm sure. But thank you for tuning in, Liz. I don't know if you have any final words or.
I do. You just cut me off, man. No, I'm just kidding. We could talk about this forever. Yes, I echo everything that you said. I want to clarify, one piece, our investment strategy. We don't go to too many details on our podcast, but our investment strategy is about identifying components of the market that have historically led to overperformance. And so what we do is we create a diversified portfolio, and then we do these small tilts towards the area that have shown very, very consistently that over the long run, you can get an outperformance. So Stefan said earlier, we're going to stick to this and this is the plan. The moment the data stops showing us, because we actually invest in a pretty scientific, academic way, and the moment that trend no longer keeps being a trend across big and small companies, US and international, stocks and bonds, right? Like we invest in a way that there is a long-term trend that shows us that we can get some outperformance by tilting in these areas. If that trend stops happening, that is when you will see us change our tune, right? We're not worried about what happens in a 6-month window, what happens in a 2-year window. We're not worried about 10 years of international not performing the way it should, because we knew that if you look at it historically as an investor, it's still worth being in. So our investment strategy is already thinking in advance about how we can get you that extra above an index fund, how we can get you, that performance that you are seeking. So those are the scenarios where you'd see us come and say, hey, this isn't due to based off of what's happening on March 21st. This is based off what's happening in the broader market. And then the last thing I was going to say is that a neighbor asked me recently, what would you tell your younger self in like 2008 when this stuff was going on, which I thought was really interesting because by then I was more worried about my job prospects in the market.
In that situation,
My student loans were, like, oh, my student loans might go down. Like I sure as hell did not have money in the market. I had student loans that I had to finance or service. But it is everything that you said where it's like, it's so easy to see it in hindsight. And I'm going to flash for a second, a third graph, but bear with me. It's so easy to see in hindsight that like, it's okay, hang in there, 2008, 2009. It's even easy now in COVID. Like, of course, it couldn't last forever, but here we are. We're at like our latest version. And we all feel, a lot of people feel like this time's different and this time we have to react differently. But if I were to tell my 2008, 2009 self, I would say, find a way while you're paying down those student loans to also get some money in the market because I was so gung-ho on getting those student loans paid off. And I would say, remember to educate yourself in the long-term perspective. And I probably would say invest in Apple. Like, come on, like, how am I not, how am I not supposed to say that? But in all seriousness, let me show you real quick one final piece. All right, so I always like to show you guys this stuff on like Google so that you don't think we're using any fancy software that you can't get access to. But again, most people are going to think of the market as the S&P 500. So this is the graph of what it has looked like to be an investor since 1996. And certainly there are some like really long, boring periods where you get a little bit of a gain, right, Stefan? We have something called the lost decade, where all you had to show for it at the end of a decade was that you kind of broke even from being an investor. But if this is 2008 and the S&P was at about 1,400 in January, then this is what someone would have lost out on where it is today, right? Around like 5,600 if they had not wanted to participate in the market. And the client that dropped out during COVID, let's see that. Oh my God, COVID's more than 5 years ago. That's scary. But let me see if I can zoom in a little bit here. And when I say client, I mean prospect. So that's a good clarification. The prospect who had dropped out during COVID sold here, was very proud of selling at 3,200. She came to me in 2023. So let's say it was January. She sold out at 2,300 and in a very short time period later wanted to know when to buy back in at 3,800. And do you see that even with our recent volatility, Stefan, like what is she still waiting? Like if she didn't buy out here and said, oh, I'll wait for the next market correction, she's still waiting. So we understand, guys, when you look at the market as a whole and you start to feel the day-to-day chaos, you are going to see a lot of movement. The 5-day, the 1 year, right? This is what we've all experienced in the last year. This is the waviness of the 6 months. But it's when you zoom out that you start to see a pattern. And that pattern is what all investment professionals love, up and to the right. Up and to the right. So this is what you experience over 1 year, over 5 years. And my God, there's never been a more beautiful graph in my book than that. So we just want to show you that keeping a long-term perspective is not just one of those fancy principles that Stefan has written down at his office, at his desk. But keeping a long-term perspective helps us all be able to participate in the market, not have to kick ourselves for losing those down periods, and not expose ourselves to extra risk by like losing our diversification that we have. So yeah, thank you so much for listening. I don't know how to do the outro, Stefan. You're the one, so like I'm gonna throw it back to you. And this was last time I said it was my favorite episode, so I guess I'm not allowed to say it twice in a row, but this was one of my top episodes.
Yeah, I didn't make that claim, so I'm gonna claim this one as my favorite episode. You can get the last one. This is my favorite. But thank you guys for tuning in. We hope you guys got some value out of this. If you guys want to hear about what we do, like what the actual plan is, what's the secret sauce that we're talking about. Trust me, I'll nerd out over our principles and get technical. I didn't want to get super technical in this conversation, but we have a lot of knowledge, a lot of resources, just like the few that Liz showed, kind of proving our point of why we just believe in what our principles are. That's what this whole conversation really comes from. So thank you guys for listening. Please, if you think this can benefit anybody that has any market fear right now, send this to them. Leave a like, drop a comment. We're on across all platforms, LinkedIn, on YouTube, Instagram. Just share this with somebody that if someone says, I'm scared about the market, please send them this video. We talked a lot about different stories, different things to help. So thank you guys for tuning in, and we'll see you guys next time.
Thanks so much. And as a bonus, they get to hear what high school Stefan was like, because I certainly learned a lot from you. Bye, guys.
You guys.